Well, good afternoon, everybody. Well, not quite everybody is out there, and it's not almost, but not quite 3:30. So we will wait a moment or six for anyone else who wants to come along, and then we will kick off. We have quite a full program. In fact, it's impossible to get all the things about audit reporting into only an hour and a half, but we're going to cover a great many things. And so I think it's now 3:30, and okay, that's enough, people. We will get on with it, and back to the slides. Right, what are we going to do? Well, we're going to horrify ourselves, panic ourselves by looking at the fact that there are 9 auditing standards devoted solely to reporting. Then we will do what hopefully will be revision for most of us, look at the components of an audit report, the types of opinion, modifications of opinion, and then an emphasis of matter paragraph, other matter paragraphs, the special considerations of first audits, then Bannerman clauses, something that should be used, I think, more widely. Very, very brief look at key audit matters. Those who went through last summer's series, there was a lot of time devoted to key audit matters in one of those sessions. If anyone's really interested, send me an email and I can send you a link to the recording for a token fee. Then accompanying information, when there's information that sitting alongside the financial statements, what effect does that have on the audit report? The special considerations of special purpose frameworks, some common problems I have seen in audit reports, and some of these you will, I hope, say it couldn't ever happen to me. Then some tips on documentation, and finally, assuming we don't run out of time, we'll have a bit of a look at some special cases of audit reporting. So, there we are. It's in the handout, so you don't need to copy all these down. There you are. We have 9 reporting standards specifically on audit reporting. The basic one, of course, is ISO NZ 700, reporting an opinion. And then we have a standard on key matters, one on modifications, one on other EOM and OM paragraphs, 710 auditing, the effects on the audit report of comparative information, or possible effects, I should say. A standard on what to do with accompanying information, one on special purpose frameworks, and then partial financial reports. So if you have a client that separates out, say, just its balance sheet for some reason, use of these is pretty unusual. And then summary financial statements. Quite a common issue when you're dealing with, say, listed companies, but not so much when you're dealing with smaller entities and and sports clubs. But there were 9 standards devoted to audit reporting. There are at least 2 other standards that have major provisions that relate to reporting, although that's those 2, ISO NZ 560, subsequent events. If things happen after the date of the audit report, then it can get very complicated. And I strongly advise anyone in that position, so that you've issued the audit report and then something happens and you kind of wish you hadn't, then look at that standard. And ISO NZ 570 on going concern, yes, there are some specific reporting matters around going concern. So, what goes into our audit report? And this is a two screen slide. We can't. It's impossible to get it all on slide and still make it readable, legible. So we have to have a title, an addressee, and what's important since the latest revision of the audit reporting standards is that then the opinion comes right up front. Now, I've put these down in what I would call a typical sequence. They would appear pretty much in this order, but the standard is remarkably, how can I put it, accommodating. A lot of the positioning of things is left up to professional judgment, but not the opinion. The opinion comes right up front after the title and the addressee. And then straight after the opinion is the basis for opinion section. Then recommended if we have an emphasis of matter because they are special purpose reports, chuck that in. Then we'll talk more about the position of abandonment clauses when we get there. I think abandonment clause actually meets the definition of an other matter paragraph, and but it's not mentioned anywhere in the reporting standards. Abandonment clauses to minimise the auditor's responsibilities. If we have a material uncertainty related to going concern, then that goes in up front there. Then key audit matters, but they're only compulsory for listed companies, and I don't yet know anyone who's started voluntarily including key audit matters in their audit reports. Then if we have something about other information, which is pretty common these days, and then further down the report we get the responsibilities of those charged with governance. They are responsible for preparing them. The auditor's responsibilities, which can be set out longhand, or we can have a cross-reference to the XRB's website. And a warning here, the auditing standards do have some examples of a reference to the XRB website, but they've changed the link. Now, if you use the old link and click on that, you are supposed to flick through to the new page automatically. I haven't checked it in a while, but when I did check it, the forwarding link was into the wrong set of audit responsibilities text. So double check that if you're not putting all the responsibilities in the audit report itself. If there are other reporting responsibilities, that's now very rare, but we'll look at one example. An other matter paragraph, if we want one, is probably going to be down near the bottom. If you're auditing an FMC reporting entity, then you're required to disclose the name of the engagement partner, but not in other cases. It's optional, of course, you may do, but you don't have to. Then there's a signature, address, and date. And those are the things that go into an audit report. My goodness me. If you're really, really old, you might remember the times when an audit report was audited and found correct, signature, possibly with a date. Things have changed an awful lot since then. The date of the audit report. Now, this is a good one, but it can be important if we get the wrong date on the audit report and something happens. The date of the audit report is important because something may happen on the day afterwards. For example, your client ceases business. Someone is saying the webinar is not showing the slides. Ooh. Is it now? I hope so. Well, thank you, John, for letting me know. I hope that that's okay now. Someone can confirm that by in the chat box, maybe. Oh, and where's my chat box gone to? It's working now. Great. Oh, sorry about that. Technology. Now, okay, date of the audit report. Now, something horrible might happen, like your client goes out of business the day after you signed your audit report. So getting the date right can be important. Is it often the case? I can only think in my career of coming across once where the date was really that crucial. But auditors nonetheless take great care to get the date right. And certainly regulators are very fierce on checking that the date of the audit report is correct. So what are the rules about dating? Well, it's no earlier on the date on which you have obtained sufficient appropriate audit evidence. In other words, you've completed the audit. But interestingly, they say, including specifically, all components of the financial statements, including notes, have been prepared. So you can't issue an audit report before the accounts have been prepared. I would hope that was kind of obvious, but nonetheless, it's there in black and white in the standard. And that those charged with governance have asserted responsibility for those financial statements, which is normally done by signing them, but it may be done in other manners. Right, so now we have a discussion point. So you've got a copy of the slides as a handout, and we have a scenario here. Probably it's a 31st of March balance date, but that doesn't really matter. Refer to that. On the 30th of June, we've got all our audit evidence except the representation letter. We've got everything else. On the 1st of July, the Board of Directors meets by teleconference and approves the financial statements. The Managing Director is authorised to sign the representation letter, and he does that and couriers it to the auditor with a copy of the minutes signed by the chairman. So on the 2nd of July, these are received by the auditor, and additional subsequent evidence is gathered. So we phone the chief executive and say, has the factory burnt down? Is everything still going on as normal? We might, if there's a big legal issue, we might get an update on legal representations, whatever. Then, because the client wasn't physically all in the same room, they had a teleconference. It's the 7th of July before directors physically find the financial statements, and they date them the date they sign them. And then 2 days later, the auditor gets them. Okay. Now, we are what? Now you should have an option to select the date that you would put on the audit report in those circumstances. And this is not hypothetical dreamed up by Bill. This is based on an actual case. And it was, of course, an issuer audit. back in the days when we had issuers. And it was, of course, an audit that the FMA reviewers had a look at. Life's like that. Okay, so we have 14 votes so far. I'm sure we're going to get some more. Yeah, 17. No, we don't have a lot of time to think about this, so we're going to have to make decisions. You do have the key pointers to the date of the audit report in your other handout. Okay, we have 22 votes. How long are we going to? Another 15 seconds. 10. 5. Come on, have an opinion. No, that's it. Right. Well, by a democratic vote, the most popular date for the audit report was the 7th of July, and that was what the FMA reviewers immediately assumed, and they wagged a finger at the auditor, and then the auditor had used the 2nd of July. And I agree with the auditor, because on the 2nd of July, have we got all of our audit evidence? The answer is yes. We had it all on the 30th of June, except the representation letter. On the 2nd of July, we have the representation letter, and we've updated our subsequent events testing. Do we have all components of the financial statements? Oh, yes. Have those charged with governance asserted responsibility? Yes, that's in the representation letter. So we've ticked all the boxes. And on the 2nd of July, I believe the audit was complete and the audit report was ready for issue. So my personal vote goes to 2nd of July. As I say, the FMA reviewers leapt to the conclusion that it shouldn't be before the date that the directors put on the financial statements. But the auditor in that case did write back and challenge the finding and said, no, we think our date is correct. And as far as I know, the FMA then agreed. So, very interesting though. Is it safer to go for the 7th or even the 9th of July? It possibly is, but if something's happened between the 2nd and the 7th, you don't know about it. So I'm personally convinced that the 2nd of July is the correct date. We will see what happens in your audits. It's a pretty unusual circumstance, isn't it? Okay, types of audit opinions. There are 4 possibilities. We can have an unmodified opinion. This, of course, is the commonest one, where we have obtained sufficient appropriate audit evidence. And so we say so. We could have qualified, we could have an adverse opinion. Qualified is an except for something or other. Adverse, we disagree. These accounts do not comply with the reporting framework. Or a disclaimer, we just don't have the evidence to tell you. Now, apart from the opinion, there are some other important things that could go into an audit report. I call them enhancements. There's a key audit matters section. Compulsory for listed companies, will be for FMC reporting entities with higher responsibility, but so far not for anybody else. And no one's doing them voluntarily. There might be another reporting responsibilities section. These are now very rare. They used to be quite common. There might be an emphasis of matter, there might be an other matter. And there might be a section dealing with other information. But none of these enhancements to the report modify the opinion. So, here we are. The unmodified opinion, we have sufficient appropriate evidence that the financial statements are materially compliant with the applicable reporting framework, which is what we aim for in every audit, but we don't always get there. So the qualified opinion, there could be two reasons for this. Either the financial statements are misstated, so we think there's an actual wrong number there, or auditors fail to obtain sufficient evidence for whatever reason, because something's unauditable or a major confirmation hasn't come through, or whatever it might be. And the effect is material but not pervasive. So we had a session on materiality. We all know what material is, and we will consider pervasiveness later on today. Right now, in fact. So to be pervasive, the matter has to affect either several elements of the financial statements, a single element that represents a substantial, an example of affecting several elements. It might be we have a subsidiary, but no subsidiary accounts have been received, so they cannot be consolidated. As far our expectation is that this is going to affect several elements of the group financial statements. It might be a single element that represents a substantial proportion of the financial statements. So if we are maybe auditing a finance company and we think that there is a major impairment that's not in the receivables book that's not being recognised, that's normally a substantial proportion of the financial statements. Or it might be disclosures that are fundamental to users' understanding. So a missing disclosure can be pervasive if it's really, really important. So you're getting the image in your mind, I trust, that pervasive is, it's a really big deal. It's really important. So have a look at this one. We're auditing a charity, DEF, and it raises 90% of its income through street collections. And you conclude that this income stream is not economically auditable, because I'm pretty sure it isn't. So, and we will have a little poll on this. You'll have to think. 90% of its income, street collections, you can't audit it. Is this immaterial, material but not pervasive, or is it pervasive? And yes, the poll was launched and then the little box on my screen vanished, but I found it. Okay, so yes, we've got, it's a close, it's no fairly close thing between, so far, no votes for immaterial. I'm sure that anyone who chose immaterial would be joking. But is it pervasive or not? Close, but there is difference. Just got a bit wider. We have 25 votes in. Come on. 27. Oh, it's got closer. The gap has narrowed. Come on, get an extra vote in. Have an opinion. 3, 2, 1. There we go. And we find that pervasive by a short head. And I'm not surprised that it is close in these areas. If we look at the definition of pervasive, does this affect several elements of the financial statements? No, this is definitely only one item in the financial statements, which is collections, donations through street collections. And so, is this single element representing a substantial proportion of the financial statements? Now, that's professional judgment. It's revenue, which is an important figure in any set of financial statements. Is it a substantial proportion of the whole accounts? And my own vote would be, if it was 95%, I would say it was definitely pervasive. At 90%, I'm wavering, but I think I would probably side with majority on that one. It is, as all these things are, a matter of professional judgment, and it's interesting that the thoughts amongst our audience today are so close, which is, I picked 90% to try and do that, actually. Aren't I wicked? Make it a tricky one. Okay, thank you very much, everybody. And we will get back to now. An adverse opinion is where the financial statements are misstated. There is an error in them, in our opinion, and the effect is pervasive. So we say that the financial statements do not present fairly, or do not give a true and fair view, or do not materially correctly comply with the financial reporting framework. So that's, I believe, the worst on a scale of harsh audit opinions. I think that an adverse is even worse than a disclaimer. So a disclaimer: auditors failed to obtain sufficient evidence. This might be the case of the unconsolidated subsidiary because all the financial information is still in Thailand or Burkina Faso or wherever the subsidiary is, and it's not arrived in New Zealand, so we can't do a consolidation. The auditors can't decide, what the answers should be, but so we don't have sufficient evidence, and the effect could be pervasive. So we disclaim and we say that we don't have an opinion at all. Okay, so prior periods. Now this is something that a lot of auditors overlook. Fortunately, it doesn't happen often, but if last year we had a modified audit opinion and the reason is still unresolved, then we must modify in the current year. Even so, as I say, it doesn't happen very often because normally these things get resolved, or it's something like a totally unauditable income stream, which applies year after year. So, when the possible effect this year is material, we have to refer to both this year and last year's figures. So it might be, for example, non-depreciation of buildings where this would have a material effect, which would be rare, but that would be, or maybe it's, we've got a financial controller who's got a real bee in his or her bonnet about depreciation as a whole and refuses to depreciate anything. Then, yeah, we'd refer to both years' figures. Or we explain that this year and last year are not comparable, because last year was wrong and this year it's right, but okay, it's not comparable. So now that's if we had a qualified audit report in the previous year. Now, suppose we had a set of accounts and we audited them and issued an unmodified opinion, and then, horrors, a prior period, an error is discovered after that. Well, it does happen that errors pop up after a set of accounts have been prepared and audited. Always, of course, we hope it'll happen to someone else, not to us, but hey, it does happen. And then, first of all, if the prior period error is properly accounted for, according to the rules of that particular framework, then all is well. If it's dealt with correctly, we don't have to do anything. But if it's not accounted for properly, then we have to express a qualified or even possibly an adverse opinion in the report on the current year's financial statements, modified with respect to the corresponding figures included therein. So that's what we have to do in the relatively rare circumstance when a prior period error pops up and it isn't fixed. Now, I think I was lucky in my career that every time an error was discovered, and it wasn't often, the client was as eager as the auditor to deal with it correctly. But if it does happen, that's what you've got to do. Now, other reporting responsibilities. So sometimes the auditor has to include things that are beyond an opinion on the financial statements. And this might be imposed by law, as it used to be under the old Financial Reporting Act 1993, which said that the auditor had to talk about whether proper accounting records have been kept, or it might be by contract. So it might be something that we've agreed to do and it's in our engagement letter. Now that's very, very rare, but it could happen. And if it has happened to you, you're probably very aware of it. Statutory obligations used to be commonplace. Now, the only one I know is on Maori incorporation. So if you're auditing a Maori incorporation or expecting to, you've got some other responsibilities. There are no requirements in the Financial Reporting Act 2013. They're in the Financial Markets FMC Act, nothing in the Companies Act, nothing in most other statutes. So the only one I've found so far, and if anyone knows of any other reporting responsibilities on auditors in the current legislative framework, please let me know, because I'm really interested. So for Maori incorporations, the auditor, apart from giving an opinion on the accounts, also has to provide a statement of the current market value of the assets and liabilities, properly drawn up to give a true and fair view. If you're familiar with Maori incorporations, you'll probably be very aware of this requirement. And it's interesting that it not only permits the use of rateable values, it actually requires the use of rateable values for land and buildings. Despite the fact that they are forbidden by generally accepted accounting practice in most cases. So the auditor has to do that, and also has to report whether or not, in the auditor's opinion, the share register and the index of shareholders have been properly kept. And I don't think all auditors of Maori corporations are doing that. They seem to have overlooked that. Wicked them. But there used to be lots of these. There are relatively few now. So, emphasis of matter. Oh, what's that? That is something that the auditor says, hey, users, you better pay attention to this because this is important. Indeed, it's fundamental to your understanding of the financial statements. And so there are some that, that come up frequently. Now, if we do have an emphasis of matter, first of all, it must be communicated in advance to those charged with governance. So we have to warn them that the audit report is going to include this, in case they get all antsy about it. There must not be a surprise in the audit report, because we all, of course, remember to attach to our engagement letters the template of the audit report that we expect to issue, don't we? Haha, I've been a reviewer, I know. So, where do we put the emphasis of matter? It's usually straight after the basis of opinion paragraph, but professional judgment may be used. The section must have a heading, which is usually emphasis of matter, or emphasis and description of what the matter is. Emphasis on use of going concern assumption, for example. It should hopefully be cross-referenced to detail in the financial statements. So you might have, as more fully explained in note N to the financial statements. And so the financial statements have a disclosure. This is commonly when it's around going concern. The full story is in the financial statements, not in the audit report. And if the full story is not in the financial statements, we are looking not at an emphasis of matter, but at a qualification. And it also is important to indicate that the opinion is unmodified. So you might end up the section with, our opinion is not modified in respect of this matter, for example. So examples, or relatively common examples of emphasis of matters, when there is significant uncertainty, and the classic one here, of course, is going concern, but there could be other significant uncertainties affecting the financial statements. If there's been a change of accounting policy with a pervasive effect. Now, this is not a wicked, bad change of accounting policy. This simply is, client has changed an accounting policy and it's a legitimate change, but the effect of the change is pervasive. That's worthy of an emphasis of matter. If there has been a major event that has a significant effect on the entity's financial position, and again, this might be fully explained in the notes. It might be that we have an operation in another country which has just enacted a law that forbids repatriation of profits, something like that. A major event, significant effect, emphasis of matter. Full disclosure in the notes, reference to it in the audit report. If we've had amended financial statements, this is where you really don't want to go, because I've held the hand of a firm that went through this, where the auditor and the directors very carefully considered an issue and got it wrong. And alas, the firm's technical department looked at the accounts after the audit was complete, and they said, oh, we have someone's chatted, RV Act, to report to the statutory supervisor. Or the Retirement Villages Act. Now that might be another reporting responsibility, but my experience of that is that they're normally a separate engagement and a separate report. But I will have another look at the Act, because I see the author those retirement villages. So maybe I've been getting it wrong. So yes, yes, it was an issuer, not a listed one, but nonetheless a fairly substantial one, and the directors and the auditors misinterpreted IFRS. Can you imagine it? They both misinterpreted IFRS. Yeah, I have a lot of sympathy for them, but they did. And so the financial statements had to be amended and a new audit report issued, and the new audit report had to have an emphasis of matter paragraph in it. And if we have special purpose financial statements, then we have to have an emphasis of matter, so we can emphasize to the readers that they are special purpose and should not be relied on for other purposes. So those are the common emphasis of matter situations. Now, an other matter is one that is not so much relevant to users' understanding of the financial statements, but relevant to understanding the audit, the auditor's responsibilities, or the auditor's report. And they are common in only in first-year audits. Anyway, as with an emphasis of matter paragraph, it must be communicated to those charged with governance in advance. There should be no surprises to the governors when the audit report comes out. Usually, it's located straight after the opinion and any emphasis of matter paragraphs. Yeah, again, professional judgment applies. It can slot in nicely somewhere else. And the heading, it has to have a heading, and it's usually just other matter. Examples. First one is prior period of financial statements not audited at all. So we say, just to let you know, the prior period financial statements were not audited. This is not to do with getting evidence about opening balances. That's a matter of if we don't get that, we have to qualify our audit opinion. This is, even if we do get full evidence, we're just telling the readers that, oh, by the way, last year's accounts weren't audited. It might be that the prior period financial statements were audited by someone else. I always think that this is a little bit on the nose, because although it doesn't say so, there's a sort of an air about it, is that there was something possibly wrong because this other firm audited last year. It's not that at all, but it's simply a statement of fact that prior period was audited by somebody else. And another matter is where we have an inconsistency between the financial statements and the accompanying information, and the financial statements are okay. The financial statements are right. There's something wrong with the accompanying information. Now, we don't audit the accompanying information. It's not going to affect our opinion. But should we tell the readers? Well, we probably should. We've noticed this. So I'll just, just to let you know, we did read the chairman's report, and we don't think he said that the results for the year were eminently satisfactory when we think they were rotten. So this is an inconsistency, and we draw this to your attention. So, I mentioned this before, I'm getting ahead of myself. First audits, we have to obtain sufficient appropriate audit evidence about the opening balances that could affect the current period's financial statements. Now, often this is done by reviewing the previous auditor's file. But note that there is no obligation on the previous auditor to make this file available. It's, and oh, we've got a question there. I'll have to carry on with the first audits just for a moment, Gordon. Right. We take over an audit, we obtain professional clearances, and then we ask, oh, we got the job. Dear previous auditor, may we come and review your file? And if they say, no, get lost, that's just the way it is. And there's nothing we can do about it. It's not common. The usual professional courtesy is to permit the incoming auditor to have a look at the file. However, it's not normal to provide the file, or it's the new auditor has to travel to the old auditor's office, and the review of the file may be supervised by an ex-auditor, the old auditor's manager or something like that, and there may very well be a charge for the time for this, and it's not automatic that any copies will be made available. It's usual to allow copies of things like marshalling schedules, so accounts receivable is made up of debtors ledger, trial balance, plus loans to directors or whatever it is, boom, 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 the marshalling schedule. So if the previous auditor says no, there's nothing we can do about it, and we may very well have to qualify our audit opinion. Now, we need to establish that the appropriate comparatives are there, but we don't need to audit it. So what we do is agree the comparatives to prior period accounts. Yes, I think we now have two questions which I'll look at when we dealt with first audits. We agree comparatives to prior period accounts. If they have been restated, so maybe there's a reformatting and things are in different order, make sure it's been done correctly. Make sure that the accounting policies are consistent with last year's accounting policies, or that changes are properly accounted for and adequately disclosed. So if the prior period was audited, then we say the financial statements of the prior period were audited by ABC & Co, predecessor auditor. And then we say who expressed, and it might be an unmodified opinion, or it was opinion, it was except for, boom, 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 and the reasons, and the date of that report. So last year's accounts were audited by someone else. That's what we've got to put in. If the prior period wasn't audited at all, we put in another matter paragraph that the corresponding figures are unaudited. Now, questions. Just wanting to confirm if you already issued an audit report and then for various reasons the financial statements are updated and a new audit report issued at a later date. Are you saying that in the new audit report we have an emphasis of matter paragraph? And the answer, yes, that's exactly what I'm saying. If we do have that situation where the accounts have to be changed and a new audit report issued, the accounts have to have an explanation of the change. So, dear shareholders, oops, we made a mistake. And the audit report, the new audit report, has to have an emphasis of matter paragraph. That's what I am saying, hope. And question, how is the audit opinion affected when you have a situation where it's the first time audit re-retained earnings brought forward? And how does this affect the following year's audit report re-retained earnings? Well, if it's the first time audit, previous accounts haven't been audited at all, then we have to attempt to get sufficient appropriate evidence on the opening balances, which includes, of course, retained earnings brought forward. And in some circumstances, usually in very, very simple entities, we can actually go back and audit the previous year's balance sheet and say, yep, that's fine. If we can't, then of course that will affect the current year's reported surplus or deficit. And so, because that might be material, we would almost certainly have to modify our opinion in respect of that. So retained earnings is part of the brought forward balances. Of course, it's generally speaking the remainder. So we audit or we get evidence over the assets, the liabilities, and things like paid up share capital, and what's left is the retained earnings. I hope that's a sufficient answer. Okay. And back to the slides. Bannerman clauses. Ah, yes. Now, it all goes back to a case, I think it was 2002, where the Royal Bank of Scotland took action against Bannerman Johnston Macleay, a Glasgow firm that, rather surprisingly, still exists, although I couldn't find any evidence that they still do audits. Bannerman Johnston Macleay audited a small group of companies, it's a parent and a subsidiary, to which the Royal Bank of Scotland had loaned some millions of pounds. That's a Scottish pound, of course. And then, as time went by, it became apparent that the financial statements that had been prepared contained what were apparently deliberate errors to make sure that the company or the group appeared to stay within the banking covenant, when in fact they weren't. One of the conditions of the banking covenant was that the company was making profits, which it wasn't, apparently. So, Royal Bank of Scotland said, we've lost a heap of dough, it must be the auditor's fault, and they sued the auditor. And the auditor said that, no, we don't owe you a duty of care. Our audit report is addressed to the shareholders. And although Royal Bank of Scotland did become shareholders I think it was to protect their increasingly perilous position, at the time of the lending, they weren't shareholders, so Bannerman Johnston Macleay and their lawyers said, no, you can't rely on our report. And the Scottish court said, well, you actually had a meeting, auditors, with the bankers, and you knew that the bankers were concerned and that they were relying on your report. And the auditors had to say, well, yes, there was a meeting. And so the judge said, well, you knew the bank was relying on your work, you owe them a duty of care. And Bannerman Johnston Macleay's insurers had to compensate the Royal Bank of Scotland. There were some, it's very easy, if there's plenty on the internet if you want to read up about this, just Google Royal Bank of Scotland versus Bannerman, or possibly even just Bannerman case, and you can find that. There's some interesting things that didn't appear to come into the judgment, like whether Bannerman Johnston Macleay were sufficiently independent. I have grave doubts about that. But never mind. The important thing was the judge said you owe a duty of care to this third party, the bank, and you are liable. And then it was, I believe, Pricewaterhouse were the first firm to start including, and sorry, I stepped back, I've missed a bit, because the judge said if the auditor did not want to be liable to the banker, the auditor could have put a message to that effect in the audit report. So it was the obiter dicta of the judge that was picked up, first of all, by Pricewaterhouse, who started putting in a little comment to say that they weren't accepting responsibility to anybody else. And it was very, very quickly taken up by the other international firms. And there was a lot of debate as to whether or not it would actually work. Now, it doesn't work in the United States for listed companies because the SEC won't accept any audit report with such a clause in it. And in the United States, apparently audit reports are generally addressed to the readers. But that's not the case in the UK or in New Zealand. And then it got tested in court. And this was Barclays Bank PLC. Barclays Bank had a go at Grant Thornton, who were auditing the VEH Eston Hotel Group. And I love this. The audit was only commissioned at the insistence of the bank. The bank demanded that the accounts be audited. So the company went out and recruited Grant Thornton to do the audit. Well, Grant Thornton were in the habit of, by then, of automatically putting in a abandonment clause in their audit reports that said they were only liable to the addressee of the report, which in fact was the managing director of the company. It wasn't even the shareholders, because it was not a statutory audit. It was only there because the bank had insisted. So the accounts, I don't know how they were wickedly drawn up. I haven't read that far, but apparently they were deliberately manipulated to impress the bank. And then the bank lost some money. So of course the bank said, well, we got an audit, so we'll sue the auditor, get them to pay. And Grant Thornton said, but no, we said in our audit report we're not liable to anyone except the addressee, which is the managing director, who was the fraudster. And they won. And the judge in this case said, well, if the bank wanted to have an action against the auditors, the bank could have gone out and contracted the auditors themselves. The bank, Barclays Bank is a big professional bank. They should know what they're doing. But they delegated the appointment of the auditors to the borrower, and they had no contractual connection with Grant Thornton, and Grant Thornton were at liberty to report in terms of their contract with the company. So abandonment clauses work. It has been tested. And why wouldn't you do it? So here's and it is not a weird and wonderful, sneaky, nasty thing at all. It is mainstream in the United Kingdom, and the Institute of Chartered Accountants in England and Wales actually publishes on their website a suggested text from which I have taken some advantage of. And so here is an example of abandonment clause on, say, an incorporated society audit. And the audit report will be addressed to the members, and we say this report is made solely to the members as a body. Our audit work has been undertaken so that we might state to the members what we have to tell them. And to the fullest extent permitted by law, we do not accept or assume responsibility to anyone else. Now, if the Institute of Chartered Accountants in England and Wales can tell its members and the world that text like that is okay, I think it's okay by me. And so I strongly support the notion of sticking in Bannerman clauses. Can't do it though if you are contracted to report to the readers. Well, you could put one in, but it wouldn't be of any effect. This report is made solely to the people who read the accounts. Yeah, it doesn't work, does it? So, after Bannerman clauses, we have key audit matters. Yeah, you've got the notes there, only listed entities and in a year's time, FMC reporting entities with high level of public accountability. What you have to do is put in the audit report those matters that were of most significance of the audit of the financial statements. From those matters communicated with those charged with governance. And from what I've read, the commonest key audit matter is the audit of revenue, which of course is compulsorily, is a rebuttable presumption, there's a fraud risk there. So it has to be one of the higher risk aspects of an audit. But don't know many people this afternoon are involved in those. Now, accompanying information. A lot of financial statements get delivered with other information. It might be the company's annual report, which is not financial statements. The financial statements are attached to the report. It might be a chairman's report. It might be all sorts of things. It might go in a little booklet that goes to the club members. The club I belong to once had at the annual general meeting handed round a set of accounts, the Commodore's report, and an obituary of a long-time member who died. So what happens? Well, the auditor, if there's going to be accompanying information, first of all, you ask the client, will there be accompanying information? Normally we know this. And arrange that it should be obtained in a timely manner, if you can. Then you read it to make sure there are no material inconsistencies with the financial statements. If there are inconsistencies, you go back and say, dear directors, your report says this, the accounts say that, which is, these can't both be correct. And normally, it'll be fixed up, they will be consistent on all as well. But that might not happen. In which case, we have to, if the accounts are wrong, we modify the audit opinion because the accounts are wrong. If the other information is wrong, we ask those charged with governance, please correct it. If they don't, we describe the misstatement in the audit report. Remember, in an other matter paragraph. We might disclaim an opinion if, because of this inconsistency, we now doubt the integrity of management or those charged with governance. This is hopefully very rare. I've never come across it. I've come across situations where I or the auditor have doubted the integrity of management, but it was based on the accounts, not the accompanying information. Or if it's really, really bad, withdraw from the engagement. That's what the standard says. Okay, so when to report about other information, accompanying information? Well, it's not simply a case of if there's other information, you've got to mention it in the report. It has to have been obtained by the date of the audit report. So, and this is not too far-fetched. It does happen that we've finished the audit and everything's there except, say, the chairman's report, because the chairman hasn't written it yet. Despite the fact that we've put it in the timetable and it's now 3 weeks overdue, it's still not there, but we're ready to finish off the audit. So we finish it off and we cannot. What do we do about the other information? Actually, nothing. But if the client is an FMC reporting entity with higher accountability, then we still need an other information section in the report if the information is expected, which it almost certainly will be. And what do we report? Well, we report that those charged with governance are responsible for the accompanying information. We probably should identify it first, but we identify this is accompanying information. It's chairman's report. It's the obituary of Fred Bloggs, whatever it might be. And then, because we have to assume that the readers of the audit report are particularly foolish or witless, we say that the audit opinion does not cover this information. And what are our responsibilities, which are to read the information and see if it's consistent. And then either we say we have nothing to report in this regard, or we describe the misstatement in the other information. That the chairman has said the results are wonderful, but the financial statements show truly incorrectly that a loss was incurred. Right. Special purpose accounts. Oh, there are lots of these now because a lot of companies are using a special purpose framework, aren't they? And there are very small not-for-profits and non-charity not-for-profits, lots of whom are using special purpose accounts and often doing it technically quite rather poorly. So, first of all, the auditor has to decide, is the chosen framework acceptable? And this has to be documented. This is a very, very common omission from the file. Because normally we say, oh yeah, it's SPFR or it's just the same as last year, that's fine. And there's nothing on the file to say so. No, that has to be documented. And when we decide whether or not it's acceptable, what is the purpose for which the financial statements are prepared? So is it reporting to the members of the club, reporting to the shareholders, but it might be something else. And the financial statements should say this already. They don't always. Bear in mind who the intended users are, the members, the shareholders, or whoever. And this one, well, what steps has the client taken to determine that the framework is acceptable? Well, the client has probably said to its chartered accountant, prepare some accounts. So we've referred it to the choice of framework to an accounting professional, and that's probably okay by us. The first two in there are the important two, in my view. Then in the audit report, we describe the purpose for which the financial statements are prepared, and if necessary, the intended users. Or we can refer to a note in the accounts that contains that information, and it really should be in the financial statements. And then, because it's not a framework that is handed down by statute, we refer to the governing body's responsibility for deciding that the framework that they have used is acceptable. Now, the framework may have a name. It might be SPFR, that's common, and it's commonly used for not-for-profits as well, even though it's designed for for-profits. But it might be that the framework is the financial accounting policies described in Note 1 to the financial statements. They may have sort of made up their own. And then we have to include an emphasis of matter paragraph, as we referred to before, alerting the users that the financial statements are for that special purpose and they may not be suitable for another purpose. So they're only for reporting to the shareholders, but we're going to attach them to the tax return anyway. So but they might not be suitable for that. So we chuck in our emphasis of matter paragraph. Common problems. This is the fun bit. These are things that other people have done wrong. Sometimes, quite often. Wish I had $1 for every time I found wrong page numbers in an audit report. Now, this is often because the client has changed the page numbers from last year, but the auditor hasn't noticed. Sometimes it defies explanation. Audit reports dated before all the evidence is collected, especially the representation letter. This is low-hanging fruit for practice reviewers to check. Now, and the FMA reviewers, when they looked at that example we looked at before, they said, aha, audit report dated the 2nd of July, accounts signed on the 7th of July, and they assumed that all the evidence therefore could not have been collected. They did not probe and ask the question. Audit report dated before client approval. Yep, it does happen. It's quite often. Now, if you're going to date the audit report before the date on the financial statements, you've got to have a well-documented reason. And it's quite rare for that to be the appropriate date. Audit reports that refer to the wrong reporting framework. You would think that this would be kind of, audit reporting 101, but hey, I've seen it. I've seen audit reports that say the accounts comply with generally accepted accounting practice. This is not a framework. The requirement is to report on whether or not the financial statements comply with a framework. So using it now, the financial statements may indeed comply with generally accepted accounting practice in New Zealand. So it's not wrong to put it there, but it's wrong to leave it at that. You have to go on and say that they comply with the framework. Using the term fairly present or true and fair view when the accounts are not GAAP accounts, not generally accepted accounting practice. They cannot therefore show a true and fair view. This is sadly really quite common. Where the governing body has responsibility for choosing the framework, then that has to be mentioned in the audit report, and often it isn't. And this is not only for those entities that can have a free choice of how they report, this is also those that are maybe tier 3 PBEs that elect to report as tier 2 for whatever reason, but they've chosen that framework. Wrong names for the main statements. Now, it's not actually in black and white in the standard, but I think it is very confusing for the reader if the financial statements say balance sheet and the audit report refers to statement of financial position. I would always slavishly copy the names of the main statements from the financial statements themselves. Incorrect addressees. An audit report on an incorporated society addressed to the shareholders. Yep, it happens. Possibly because someone's picked up the wrong audit report template. I don't know how it happens, but it does. And it makes the auditor look like a wally. Incorrect references to legislation. this is almost an epidemic. I've seen audit reports that on incorporated societies that refer to the Companies Act. On many occasions, I've seen lots of recent audit reports that refer to the Financial Reporting Act 2013, which is hardly ever the governing legislation of the financial statements. So, yes, make sure that you're referring to the right legislation. You wouldn't believe it, but yes, we do get audit reports that don't seem to know whether they've issued a modified or an unmodified opinion. I have seen opinions that were clearly headed qualified opinion and basis for qualified opinion, and then at the bottom reference to our unmodified opinion, and our unmodified opinion was issued on such and such date. Other inconsistencies within the report, all sorts of nonsenses. Blanket modifications. Yes. Oh, it's a not-for-profit, so I'll qualify on revenue. And the audit report qualifies on all revenue streams. Now, this is not very helpful with to the readers, because that gives them no assurance at all. And then you look in the file and you find that some revenue streams have actually been audited, like the interest and the trading income. It was just the donations and bequests that weren't auditable. Failure to carry through prior year modifications. The circumstances where they have to be carried through are limited, but yeah, it's quite common. Plural for singular or vice versa. Now, you should know your clients and know how many shareholders they have. If it's one shareholder, why would I address my report to the shareholders, plural? And again, with directors, is it one director or many directors? And finally, spelling and grammar mistakes. Now, I come from a family of grammar Nazis, and we kill ourselves laughing at the dumb things that people do, and that shouldn't happen in professional writing like audit reports, but it does. And what's the effect on the reader who finds that something has been misspelled? I mean, what do they think of the auditor who cannot spell something? It could be the name of the client. I've seen those misspelled. I've seen completely the wrong client name, because presumably someone's picked up another audit report. Often it's in a group. Oh, I'll pick up, no, where's the audit report I did yesterday for the other subsidiary? I will edit this. And it's not edited properly. So you really look a wally if you are going to make spelling and grammar mistakes, and many of these other mistakes really are inexcusable. Statements of service performance have a few special things of their own. So there's confusion about whether the statement of service performance has to be audited. If it is audited, then the ISAs don't apply to the statement of service performance, because that's not financial information. So we need to refer in our audit report not only to compliance with the ISAs, but to ISA NZ 3000 as well. If a statement of service performance is presented but not audited, and this is quite common now, because very small entities, including charities, use Tier 4 reporting, and they don't need a statutory audit, so they don't have to get the statement of service performance audited, but their own constitution says that the financial statements will be audited. So the auditor says, okay, that's fine. Here's our engagement letter. We will audit the financial statements, but not the statement of service performance. In that case, the SSP is other information, and we need an other information section. And lots of auditors don't know about the XRB's guides, explanatory guideline AU9 and AU 9.1, which is reporting on tier 3 and 4 entities. Download them free from the XRB's website. Rare problems, but I truly have seen this audit report dated before the end of the accounting period. The auditor's embarrassment was extreme. And as I said before, I've seen the wrong auditee name, the wrong entity. So when I first became a partner at Bowden Impey and Sage, long ago, I was given two pieces of advice by Tony Sage, who was at that stage just retiring as a partner. One of them I forget, I confess I've forgotten, but the other one I have not forgotten. And he said, always read an audit report twice before you issue it. Now, I probably didn't always read it twice, and certainly I didn't read it twice on the sole occasion when I had to phone the client and say, oh, I need to get those audit reports back, there's a mistake in them. That happened only once. But that's really, really good advice. And if we are relying on assistants to draft the audit report, then that's got to be, the more junior the assistant, the more important it is that someone like the partner also reads it before it goes final. Okay, documentation. This isn't out of any particular auditing standard. This is Bill's advice to auditors. Documentation around the audit report. Now, first of all, the partner will confirm that sufficient appropriate evidence has been obtained. Nearly all audit files do this because it's part of standard documentation. If you're using, for example, Audit Assistant, there's a bit where you confirm that, yes, we have got sufficient appropriate audit evidence. That's good. This isn't always there. If we modified our opinion, it's a really good idea to have a little essay on the file explaining in clear language why. It might be obvious to you or to another audit professional, but if it's at all obscure, and it's a good practice to document that. Even more important, if it was a close call, document your reasons for not modifying the opinion. Now, because think of it, if I modify my opinion and that was too cautious, I really didn't need to, where's the risk? Well, I might have a miffed client, but probably nothing worse than that. But if it's a close call and I finally decide I'm not going to modify the opinion, that's where the risk is. The risk that in fact we should have modified the opinion. So if it's a close call, but we decide, no, we don't need to modify the opinion because we, maybe got an EQCR or second partner or another practitioner to discuss, and we say, no, we're not going to modify. Really important to document why not. The FMA reviewers specifically look for that for auditors of FMC reporting entities, and it's a damn good idea. And when you're considering, is it material but not pervasive, or is it pervasive? Again, write down your reasons. In that example we had earlier, why you thought 90% of revenue is pervasive or not pervasive, they're both tenable professional judgments, but document how you came to it. And so, again, any other modifications to your report, document the reasons why, or why you chose not to modify. So it's I know it's at the end, we're under time pressure, we want to get the job finished, get the audit report out the door. We're remembering, oh, we've got to carry on our post-balance date work up to today. It's very easy to just make the decision, issue the audit report. We do have to, it's really, really important to document our reasoning, unless it's really, really obvious and clear. Okay, now we have only 5 minutes to rush through a few notes about reporting in the unusual situations, and I was concerned that we probably wouldn't have enough time for this. This is for summary financial statements. So our client has issued summary financial statements, and we're invited to attach a report to those. Well, we might have to use one of those two phrases. Are consistent in all material respects, or are a fair summary of. If you have, and I do strongly advise you to read the standard if you are in this position. And there's an example in your notes. Inconsistent in all material respect in those things with financial statements, and referring to FRS 43, the reporting standard on summary financial statements. The audit report, pretty much what we would expect, except that we have to not only identify the summary financial statements that we are reporting on, we have to report on the full audited financial statements, identify those, which may not, of course, be attached to the summary, but and things like they were dated, they were completed and dated in the audit report, blah, blah, blah. We have to state, because the readers are mentally defective, that a summary does not have all the disclosures of the full audited financial statements, and there's no substitute for reading the full financial statements. If the date of the report on the summary is not the same as the date on the full report, obviously it can't be earlier. Explain the impact of the different dates, and everyone's responsibilities, signature, address, date, the usual thing. Compliance audits. You get a few of those. The commonest one is real estate agents' trust accounts, which is compliance with legislation. And what do we have to do? Well, we have to give it a title, an addressee who we're reporting to, and then we have to say, are we giving reasonable assurance or limited assurance? This is a positive opinion or a negative opinion. What are the compliance requirements? Requirements to comply with the particular act or regulations, period or date being reported on. If it's an attestation engagement, the client's statement of compliance, which the criteria used, that's normally in the legislation that you're referring to. Any inherent limitations, you have to say that the engagement was performed in accordance with SAE 3100 brackets revised. You have to state, as you do in, or more or less have to do in a full audit report, regular audit report, that the firm applies PES 3. And explicitly state compliance with independence and other ethical requirements. This is, of course, to bring it in line with things we have to put into a regular audit report. A summary of the work performed and identification of any other relationship, all the usual things. Any other relationship is sneaked onto 2 slides. Sorry about that. if you're doing a compliance audit, then you might be well advised to refer to the standard SAE 3100, and you've got paragraph numbers there if it's a long form report. If we have multiple conclusions or opinions, now we haven't discussed this afternoon multiple qualifications. That can be really, really tricky. It would have taken up a lot of time. Again, refer to the standard if you have emphasis of matter or other matter paragraphs, if you have modified any conclusions, or if you've limited the scope. And here, just at the end, and it's in your notes, examples of reports on single financial statements. That's the example for a balance sheet, and that's an example of a receipts and payments statement. You've got the list of standards in the notes. So if you do, it's very rare. I don't think I ever issued a report on a single financial statement. I can't remember it. But you go to the statement, to the auditing standard, or of course, contact us and we will assist you in reporting on anything that's unusual. So I make that just past 5 o'clock. We have covered a whole lot of time, a whole lot of material, and we have had 3 questions that have been answered. I hope everyone's happy with the answers. Sorry, not very many polls today. There's a lot of listening and not a lot of trying to make decisions. So that is it for today. The next webinar is on Thursday, the 1st of February, which is, oh, hang on. Yes, Thursday, the 1st of February on errors and exceptions. Yes, and you can guess from that that it's not entirely written yet, but it will be written by the 1st of February. Okay, look forward to meeting you all again then. So farewell and have a good evening. Bye.